I want to really welcome all of our friends, stakeholders, shareholders to our 2023 Worldwide Healthcare Trust annual meeting. It's really great to see, it's like I've been doing this for quite a while, and it's terrific to see so many old friends here. It's like so many people I've seen here 25 years, and so on coming. Now, what I'm going to run through today is, first of all, I'll give a quick OrbiMed update, and I will go over our performance for the last fiscal year. And then, most importantly, I will talk about the portfolio positioning and the investment themes. But before I really start with my formal part of my presentation, what I do want to start is with this being a sad day, because we have to say goodbye again to another director, and Sarah Bates, she has been for 10 years on the board of directors, and Doug will have more comments on it. But what I want to thank on behalf of our OrbiMed team, thank you so much for a really incredible tenure run on the board of directors. A director like Sarah, she gives incredible input, I think, to the portfolio managers. And, Sarah has made OrbiMed a better firm and a better portfolio manager. So, Sarah, thank you so much for your really exciting run on the board of directors. You will be dearly missed. Coming to OrbiMed corporate update, OrbiMed is a very, very stable firm. We have approximately $18 billion assets under management. This makes us one of the largest healthcare managers out there. You see here the spread of our business. You see here very, very diversified, royalty funds, Asia-centric private equity funds. Then we have a very strong US venture capital business. Here you see the public equity sleeve. And here, most importantly, Worldwide Healthcare Trust, which is our largest fund. It's our second oldest fund in our stable, but it is by far the largest fund, and it's our true flagship fund. We're very, very proud of it. Now, the key asset of OrbiMed is the bucket below. This is 139 employees. This is up from approximately 130 employees a year ago. This is our most valuable asset inside the firm. At the end of every single day, the most valuable assets walk out of the door. This is the key assets, why we have a key ingredient to long-term success. Without it, without these 30 PhDs, 15 ex-biotech CEOs, we couldn't run this fund. So this is really the key for our success. Coming to our performance for 2023. Now, the previous two fiscal years we had, like fiscal year ending 21 was one of the best years in our history. Ending 2022 was one of the worst years in our history. Last year was a mixed bag. It started out a bit difficult. We were ahead of our benchmarks for a while, and then at the very end, we just ended up flat for the year. We got slightly beaten by the benchmarks. And if we look under the hood a little bit by the separate periods, there were quite a few distinct periods. You hear so, and I talked about it already at the last annual meeting. April, May for our current fiscal year were quite difficult. This was a continuation of the big macro themes. You had the war in Ukraine, you had inflation rising, interest rates rising. So it was a very difficult market environment for a fund which invests in a lot of innovative and growth companies. And that continued here in May and April. Then the summer period was really interesting, because there it reverted to a fundamental theme. We had M&A happening. We had some great clinical trial readouts happening. And then when fundamentals were driving the stock market, we really outperformed. So here we got really back into old form, where we by far outperformed the MSCI Worldwide Healthcare this period, like 900 basis points. And then unfortunately, like in the fall period, stock market got really tough. Everything got defensive. Macro themes were overhanging the market again. And then we had a little bit dip versus the MSCI. Big cap drug stocks outperformed. And here then the start to the end of the fiscal year, A little bit got unlucky here in March. I wish we would have beaten the benchmark, but then you had like a banking crisis with Silicon Valley Bank, and it hurt a little bit the results here in the last 3 months. But overall, actually the fund again started outperforming. So how did we do by subsector during the fiscal year ending 2022? Here you see the MSCI plus 2.5%, and the by far biggest positive contributor was emerging biotech. And there in particular, 3 M&A acquisitions were really driving it. We had Seattle Genetics takeout, Turning Point, and Global Blood. So 3 buyouts of portfolio positions were really driving a very encouraging subsector performance in emerging biotech. Large cap pharma was positive. Japan with 2 holdings in Daiichi and Eisai was positive, and then service and tools as well. On the negative side, it was emerging markets was really difficult. So India slightly negative, China significantly negative, and then spec pharma was really one name which we had a poor exit. This was unfortunately just before and takeout. But those subsectors were in the red for the year. And here you have the key names on positive contribution and negative contribution. I mentioned already Global Blood and Seattle Genetics, 2 of the 3 takeouts that we had. Daiichi Sankyo, really innovative oncology company in Japan, positive contributor there. And then 2 biotech stocks, BioMarin and Sarepta, which are both in the orphan disease space. On the negative side, here you see one of our big winners actually in fiscal year 2021, Shanghai Biohart, that reversed. The company went public, really successful IPO. But as it came towards lockup, actually shares sold off together with the market, and it was our largest holding in China. And then you see here Mirati had a negative clinical event. Horizon Therapeutics is the spec pharma name, where we had some unfortunate timing with our sell. So how has the fiscal year started? We started on the right footing here. You see Worldwide Healthcare Trust, up 2.5% for the period ending June 30th. And the MSCI Healthcare is a little bit out of favor in this current environment, and it's actually down on the year. So we have some good alpha, and you look on a calendar year basis as well. We have some really solid alpha there of 500 basis points on a year-to-date basis. Now, we are obviously really proud of our long-term record, and we are proud, being in existence for 28 years and having a really, really great long-term success here in the fund. But the key thing what I want to actually talk about on this slide is what we need to do better. It's like, I don't want to rest on the laurels of our long-term track record. There are 2 things what we really need to do better. Number one, if you look here in the upper right corner, our 3- and 5-year performance, we have underperformed our benchmark. We got to bring that performance up. There is no question about it. The key driver behind the underperformance has been our fiscal year 2022. I talked about it in detail, that us with our strategy of being heavily exposed to the most innovative, higher growth companies, many times smaller mid-cap companies, has been a great recipe for success for the past 28 years. But during that year, it was the wrong strategy. And this created, I think, that we are lagging behind on the 3 to 5 years. And we have to do better. We have to improve. We started out on the right footing this year, but we have a lot of wood to chop. There is still way to go that we are to catch up with our benchmark. The second part where what we want to improve is, you see here the gap between the net asset value and the share price. And this has been an industry trend where the discounts to NAV have been widening. Industry-wide, I believe, the latest numbers are close to 15%. discount on average. We have been trading for a number of months, close to 10%. You've probably seen we have been very actively buying back our shares. Our share bags are, I think, on a year-to-date basis, is one of the largest in the industry, if not the largest. We do want to go back to a lower discount. The target is 6%, but there is an outflowing tide inside our sector. But we are striving for narrowing that gap, and obviously, we hopefully at some point go back to a premium again. And you see that the period 2018 to 22 was a period where everything traded at premiums. We're hopefully going back to a more normal environment like that. But in the meantime, we will be actively with our share buybacks to support the share price. But the key question, and the key question what I want to answer to our shareholders is not like talk about the past, but talk about the future. And is the recipe for success for this long-term track record, is that still in place? And I do think so, and I will talk about some of the themes, but I do think that there is a big dislocations in the healthcare market, and I feel very, very confident that we can replicate in future years a similar success what we had in the past. So with that, I come to the investment themes, and there are basically 4 broad categories what I want to cover. Number 1 is a very, very important overhang that got lifted over the past year, which is drug pricing in the United States, or drug pricing reform. Number 2 is probably the most important trend for the next 18 months inside our sector. This is an accelerating pace of M&A. Number 3, that's the reason why you are in this fund. You want to be here for all the exciting innovation in the healthcare field. You want to be there to participate with the new blockbuster drug launches. And then number 4, I'm going to talk a little bit about the dislocations in the markets what we have seen, in particular the dislocation in some of the subsectors in the healthcare space. So coming to the first point, US drug price reform. Well, finally it happened. It's like I've been in this business for the past 30 years, and for the past 30 years, we've always talked about drug price controls in the United States. It started in the early 90s with Hillary Clinton, and this has been always looming on the horizon. And obviously the industry is dealing with drug price controls in many markets like Japan, like China, or in Europe. But finally, as part of a legislation called IRA, we got a sign-off on some drug pricing. So this is the first time that the Democrats got a bite at the apple of drug price controls in the United States. Now, there was some good and there was some bad. The good thing was, the drug pricing inflation cap. I think that's neutral. Actually, a high inflationary environment, drug prices are going to rise in line with inflation. The good part, the positive part, is Medicare Part D reform. This will lower the out-of-pocket expenses for the elderly, and I think will be in general a boost, I think, for drug consumption. The negative part is that starting in 2026, it starts with the top 10 drugs for the elderly patients, also the elderly population beyond 65. There will be some drug price negotiation by the US government, and this will expand it year after year by additional 10 drugs. The good part about it is it's a little bit in the future. It will be scaled in over a number of years. And now we know what the rules of the road are. This is the important thing, that we are finally having actually this overhang removed, that we know what will happen actually with drug prices. Now, what are some of the key executives actually saying about the IRA? And this is here, Dave Ricks, he's the CEO of Eli Lilly, and over the past year, Eli Lilly has become the -- 1 healthcare company in the world. It has surpassed United Health, the behemoth HMO, surpassed J&J in market cap. And he kind of agrees with my talking points from the previous page. So he thinks drug price inflation cap, nothing burger, Medicare Part D redesign, I think is a net positive. And he's disappointed, about the Medicare price negotiation, and he's especially disappointed that small molecule drugs get only a 9-year protection, while biotechnology drugs get 13-year price protection. Now, a key thing is actually the pharma industry has started to fight back, against the U.S. government, and they have, went to court, and there are a number of court proceedings going on. And there is a chance, actually, that things could change, that part of these drug price controls will be watered down. So I think we know the base case scenario, and there are possibilities that it actually improves, and that would be a big shot in the arm, I think, overall for the sector. Now here I'm coming to the most important trend inside our sector, which is M&A. Why is M&A happening in the biotech sector right now? It's really straightforward. Big pharma companies, they go through cycles of big patent expirations. So there was one big cycle in the early 2000s. Another big cycle was there 2012 to 2013. And here we have in 2025 another mega patent expiration cycle happening. You see some of these monster drugs here like Humira from AbbVie, it's expiring actually, the patents expired this year, genericization is happening right now. So all of the big pharma companies, they have one thing in common, they have a big pipeline gap, a big revenue gaps in the years 2025 onwards. What do they want to do? Well, they want to buy revenue. So what every single one of the large pharma companies is trying to do is they're going to try to find a biotech company or a specialty pharmaceutical company which has a product which is getting launched by 2025. And the target is always, it got to be at least $1 billion in revenue potential. And this is the strategic agenda for every single major pharma company. And they are going to step on each other's toe over the next 18 months. To acquire small to medium-sized biopharmaceutical companies. And it already started happening. I mentioned before, we had a biotechnology bear market. And every biotechnology bear market for the past 30 years always ends with one thing. This is when M&A starts happening. And this started here in the second quarter of last year. And we had inside the trust, for example, Turning Point acquisition by Bristol Myers. Then we had later in the summer Global Blood acquisition by Pfizer. And then this year Seattle Genetics acquisition by Pfizer. And you see here a cluster of a couple of companies, like GSK, very, very active. Pfizer, extremely active. Even the largest pharmaceutical company in the world, Lilly, extremely active here just in recent weeks, two acquisitions. But there are a large number of big pharma companies out there who haven't made major moves yet. They have a lot of cash on their balance sheet. All their competitors are buying, and they haven't yet made a move. The total balance sheet flexibility for big cap pharma is $1.5 trillion. Just for comparison, the total market cap of the whole biotechnology sector is $250 billion. So basically the top 15 pharmaceutical companies, they could basically buy the whole biotech sector out of petty cash. So there is a ton of cash available for those acquisitions. And what are they buying? Well, it's really straightforward. I told you, what the strategic agenda is. A drug with $1 billion plus sales potential from 2025 onwards. Here you have listed 50 novel biotechnology drugs with $60 billion in sales potential. You expand that list to 25 products, you get another 20 billion. This is the solution to the big pharma problem. And these are the names what big pharma companies will acquire over the next 18 months. And if you put together, a group of 40 names or so, you have a surefire way to probably get 50% of the acquisitionings happening inside the sector. And this is one of the big themes inside the portfolio. All of our small mid-cap holdings, they have always optionality of M&A as part of the investment thesis. And then we do have a basket, which is called when you look in the annual report, it's an M&A basket. That's a grouping of the 40 most likely names. And that's one of our largest holding inside the biotechnology sector. So the M&A theme is a really core central theme to the portfolio. And I think it is the most important theme for the next 18 months. We always like to talk about innovation, and this is the key long-term theme inside the trust. This is why healthcare is a terrific sector to be invested in it. And the pipelines are definitely full. You know, you see here since 2016, total numbers and compounds under development increased by 70%. The biggest driver there is oncology area. But you see there a little bit of plateauing of the oncology space. And I think other disease categories like immunology and CNS are getting ever increasing popular there. But pipelines are definitely full inside our sector. I showed this slide, last year, and I was, this was the next big thing. And I mentioned here that there are a number of key data readouts in 3 key categories for on innovation in the healthcare space. And there was all of these data readouts in oncology, for the obesity drug, and Alzheimer's disease drugs. And you see here, with the exception of one, which was actually expected, all of those clinical trial data readouts have been positive. So there has been a tremendous flow of terrific news actually inside the sectors. And probably everyone knows here, obesity is going to become one of the biggest drug categories there. The drugs by Novo Nordisk and Eli Lilly are going to be mega blockbuster drugs. There is no question about it. Both names, for example, Lilly and Novo Nordisk, are well represented inside the portfolio. We talked last year about the antibody drug conjugate category in the oncology space. This is really the next big thing in oncology, and HER2 is a $15 plus drug. This is with Daiichi and AstraZeneca. This category is just going from strength to strength, and it's going to be the next mega blockbuster drug category in the oncology space. And then Alzheimer's disease, and I've talked about Alzheimer's disease for many, many years. And finally, actually last year has been the year where we had 2 drugs with positive data in Alzheimer's disease, one from Eli Lilly, another one from Eisai together with Biogen. The Biogen Eisai drug is getting launched at the moment, got just full approval a week ago. And this is another mega blockbuster drug category. It will be a little bit a slower launch than weight loss or the oncology space, but this is going to be a multi-billion-dollar new disease category. So really good news, I think, on an innovation side and over the past year. And here I show the has-beens and the next wave. It's like the has-beens, it's like these are the old drugs. These are the currently largest selling drugs or largest selling drugs in 2021. You obviously have the big COVID drugs, which are a thing of the past, luckily. Humira expiring, Keytruda, largest selling oncology drug out there, losing patents. All of them, they will disappear, and they're going to be replaced by really those categories what I mentioned just before. Weight loss drugs with Eli Lilly and Novo Nordisk leading the way. ADC drugs and HER2, Dato, AstraZeneca, Daiichi, Bristol Myers, some new immunology drugs which are going from strength to strength. And then you have down here the 2 Alzheimer's disease drugs, what I talked about. But this is as well a very important slide because not all pharma companies, big companies, are exposed to it. It's very narrow. There are some really clear winners like a Novo Nordisk or a Lilly or an AstraZeneca, and then many losers, And the losers, they don't have a choice. The only way to get a solution to the patent expiration problem It's the same old M&A. They have to do M&A. So you would imagine, with all of this great fundamental news happening, that the sector would be performing really well. It's M&A. This got to be good for stock prices for biotechnology stocks. Well, not quite. And here you see XBI. That's the Emerging Biotechnology Index, and that shows you the relative performance of the XBI versus the S&P. And you see here peak to drop minus 77% underperformance versus the broader market. In an absolute drawdown, it's 65%. So this biotech underperformance, biotech bear market has been now the longest lasting, the biggest absolute drop, and the biggest relative drop versus the market. So there has never been in the history of the biotech sector actually 2 years in a row of negative performance, but we had them 2021, 2022. I wager a bet we're not going to get a third year. And that bet is reflected very well in the portfolio. But this is, I think, in my 30 years history, investing in this sector has been probably the biggest dislocation I have ever seen inside the sector. This is bigger than when in 2002 the Nasdaq bubble burst. This is a bigger dislocation than during the financial crisis years of 2007 and 2008. And here as well, you see here, healthcare. This is the whole healthcare index, so this is not just biotech. This is year to date, and we are like at the bottom of the subsector performance vis-a-vis the rest of the market. Well, healthcare stocks, they do use some artificial intelligence, but they are not as part of the artificial intelligence theme. So they are not in favor with this very, very narrow market advance. But this has created, as I mentioned before, some very significant dislocations. And I like my chances here going forward that the healthcare sector broadly will rebound. And in particular, some of the innovative higher growth companies will rebound even stronger. This will bring us to the portfolio positioning. And here you see, all our sector representations. So you see pharmaceutical sector, 26% of the fund is invested in pharma. That's down from a little bit over 33%. So these 26% include some of the high growth winners, like a Novo Nordisk, Lilly, and AstraZeneca. But we are avoiding all of the companies who are having these big pipeline gaps in 2025. Going forward. So we are structurally underweight the pharma space. We are significantly overweight the biotechnology space. This overweight has increased over the past year. So it is now 28% of the fund is in biotechnology. We have a significant underweight in life science tools. A very big overweight in the medtech devices space, and this has been, medtech devices has been one of the key subsectors for the recent outperformance of the fund versus the benchmark. We are significantly overweight versus the benchmark. That sector has done extremely well because revenue growth has been exciting in the first half of the year. Everyone actually in the United States is going to the doctor, getting their hip replacement, their knee replacement, all of the orthopedic procedures done. So volume growth has been terrific, and that has driven actually performance on the medtech space. Healthcare services had been an overweight, and then Japan as well. We increased that significantly over the past year. Our two key holdings there, Daiichi and Eisai. Daiichi, oncology company, and Eisai, an Alzheimer's disease company. The one area where we've reduced exposure vis-a-vis the last year has been emerging market. It's been partially share price performance. I mentioned before, it's been very tough performance over there, but partially as well some sales. I think the valuations are extremely attractive over there in China in particular. But I do believe that the near-term balance is probably easier to be had in some other areas which had been dislocated, like the small cap biotechnology companies. So that's why we haven't yet doubled up in that area. And I would expect the weighting to stay approximately same in emerging markets. Privates at probably approximately the same level as before. And here notable as well, we increased our gearing a touch, so it's now 115%. It shows here as well our increase in the gearing to 115 over the past year. Now coming to the portfolio, it's like here you see, I think, our key holdings above 100 basis points. So you see all of our biotechnology names. I talked about the big pharma companies with AstraZeneca, Novo Nordisk being the two largest one. In the medtech space, Intuitive Surgical and Boston Scientific. And here you see like all of the other names are listed there. It's a very, very actively run portfolio, so 70% active share. And as well, quite concentrated. Our top 30 names, represent 93% of the NAV, and our top 10 names close to 50%. With that, I come to my concluding remarks, and I hope I leave you with that I feel very, very strong about the outlook for the Worldwide Healthcare Trust. I think we have our markets are extremely dislocated. Some of the key overhangs have lifted, and the fundamentals are very, very strong. Innovation is happening, key new drugs are getting launched. So I feel pretty good that we can, I think, further improve, on our financial results. And with that, I would maybe open it up to questions related to the portfolio.